So I will kick off this morning, or this afternoon. In a moment, I'll invite our speakers to introduce themselves. But before we do that, I'd briefly like to set the scene for today's webinar. Adaptation finance is about helping communities and organizations reduce the risk they face and the harm they may experience from climate hazards, such as storms, floods, and drought. It plays a critical role in building resilience in the face of increasingly frequent and severe climate impacts. Adaptation finance comes from a range of sources. This includes public investment by governments, as well as finance from private sources, such as philanthropy, corporations, and financial institutions. We're also seeing growing engagement from businesses, which are investing in adaptation to safeguard their operations, supply chains, and markets from climate-related risks. So I'm pleased to have our four speakers here today to speak to different elements of adaptation finance. At the same time, adaptation finance can be challenging to define and track. This is partly because it's highly context specific, and effective adaptation requires a wide range of activities tailored to unique climate risks faced by particular places and communities. And unlike mitigation finance, which is often focused on a more clearly defined set of solutions, adaptation does not lend itself to a single standardized approach. So during today's webinar, you'll probably also hear us reference funding. By this, we simply mean the actual money provided for a specific purpose. And you'll also hear about transformational adaptation, which sits at the heart of our work in the MACC Hub. Transformational adaptation goes beyond incremental change, focusing instead on actions that lead to fundamental shifts in systems, structures, or functions, transforming places in ways that deliver deep and long-term and sustainable societal change. So just to set the scene a little more before we crack into the body of today's discussion, and to give a sense of scale to the challenge, the Climate Policy Initiative estimates that around 68 billion was spent globally on adaptation on average between 2021 and 2022. However, this falls far short of what's actually needed. In developing countries alone, the adaptation finance gap is estimated between 187 and 359 billion per year. That is the context that brings us all here today. My name is Sive Sheeran. I work for the Greater London Authority, specifically the London Climate Ready Partnership, who are a member of a partner in the MACC Hub. So thank you very much for joining us. I have a few housekeeping points, if that's okay. Please use the Q&A function to submit questions at any time during the webinar. We'll address as many of these as possible during the Q&A session at the end. And today's session has been recorded, and this recording will be shared with you after the event via email. I'm going to keep a close eye on time, and we'll aim to finish on the hour. So that is all from me, really. And now I would like to invite our four speakers to introduce themselves. Andrew, perhaps you'd like to go first.
Thanks so much. Good afternoon, everyone. So I'm Andrew Forsyth, and I am the Head of Climate Resilience and Sustainability at Zurich Resilience Solutions. So those who don't know, Zurich Resilience Solutions are the risk advisory and risk management part of the Zurich Insurance Group. So I lead our climate resilience work here in the UK, and we have teams all across the globe doing very similar things. And I guess a simple way of describing it, and a way I try and describe it to my parents who still don't really understand what I do in my job, is we're in the pre-insurance space. So we are really trying to help and support, identify, manage, mitigate risk before you then are left with what you need to transfer over to insurance companies. So I'll talk through today a little bit what we're seeing in the private sector, in the insurance world, and also give some stories and some case studies from our customers. Hopefully brings this to life a little bit as well.
Thank you, Jonathan. Sorry, no, thank you, Andrew. It's great to have you. Jonathan, over to you.
Yeah. Hi, everyone. Really glad to be part of the call today. My name is Jonathan Amung, and I'm a Senior Policy and Climate Adaptation Policy and Programmes Officer at the Greater London Authority. And one of my jobs is leading on the investment planning work for the upcoming GLA and London Council's-led London Heat Risk and Investment Plan. And I'll be sharing some of our emerging perspectives on adaptation finance from our scoping work that's shaping how we think about funding heat risk mitigation in London. And just as a caveat, we're very early stage in this journey, and it's a new area of work, both for myself and the team. But I hope some of the insights that I'll be sharing resonate with those navigating questions around adaptation finance similar to us. Really looking forward to the conversation and especially learning from other panelists on the call. So thanks for having me today.
Thank you very much, Jonathan. Normally Jonathan sits opposite me in the office, but he is at home today. Laura, over to you.
Thank you, and hi everyone. My name's Laura Lifton. I work at the Environment Agency. I manage a team who are responsible for overseeing delivery of the Thames Estuary 2100 strategy, which is a long-term adaptation strategy for the Thames Estuary, looking at how can we adapt our riversides to rising sea levels and increasing tidal flood risk over the rest of this century and beyond. And today I'll be sharing some recent findings from a piece of work that we've done to look at alternative ways that we could fund or finance delivery of the interventions needed to ensure that we can continue to keep the Thames Estuary resilient to climate change in the future.
Welcome, Laura. Thank you very much. And Sasha.
Hi everyone, my name's Sasha Abraham. I work at Climate Policy Initiative, which is an international non-profit which focuses on global climate policy and climate finance, including the stats that Steve mentioned earlier on adaptation finance needs and flows. But I'm based in our London office and I really focus on the tracking of adaptation finance and thinking about how we can both collect, track, analyse and improve the climate finance data and what it tells us about what needs to be done.
Thank you all. I'm going to go over to the first question now. I'm just going to come to you, Andrew, around what funding models and financial mechanisms are currently available for adaptation in the UK.
Yeah, thanks. And I think, as you mentioned at the beginning, sort of some of those. So I guess I'll reiterate that. And I think the key thing here is that it's ever evolving, it's expanding. There is finance becoming, more accessible, but I think I'll go on to maybe slightly challenge some of those as well. So, there obviously are big programs of public funding on a multilateral or government level. Blended finance is starting to come in as well, which I guess is really looking to de-risk projects around the stuff, and that's something that that's in our world of sort of de-risking, and what does that look like? And then I guess maybe where people would jump to if we talk about financing is that private sector, sustainability or climate linked loans that the sort of banks will give out. I mean, in my world, the conversations that I have sometimes on a weekly basis with some financial institutions and banks as well, if the insurance industry won't insure, then we won't lend. So we're getting into that space in terms of everyone is interested in, in what other people are saying around climate risk. I guess a key point here when we talk about funding models, financial mechanisms, even the word adaptation. I don't want to be sort of too controversial right at the start of the webinar, but I think part of the challenge is that adaptation, resilience is still seen as separate or siloed. That, oh no, it's a new thing, it's an additional thing, it's another burden or thing we have to find budget for. And I guess a key challenge I put to businesses is actually that this is not new. This is this is a major risk, and the World Economic Forum global risk report was out recently and confirmed that climate change is still a top risk in the short term and even more severe risk in the longer term. Therefore, this is a business risk. This is not your sustainability officer, his role to fix in one part of the business. It shouldn't be siloed. Adaptation to climate change, it's about buildings, it's about logistics, it's about people, it's about finance, it's about legal, it's all these things together. So, I guess that's sort of a slight challenge right at the beginning when we talk about this is, yes, how do we finance adaptation, but also how do we integrate, the management of climate risk and therefore what's needing to be done about it into that business as usual position. So yeah, I'll leave those sort of first thoughts there, and really keen to sort of get into that more as we go through the conversation.
Thank you, Andrew. Yes, certainly. Hope as we go through it, we'll be able to get into that in a bit more detail. Jonathan, coming to you from your work on London's heat risk investment plan, I know you're at the beginning of it, but what does the evidence tell you about how heat risk adaptation is currently being funded and financed?
Yeah, thanks, Saad. So as you said, to respond, I'll be drawing on some of our baseline research as part of the heat risk and investment plan. So as mentioned before, we're developing a plan which will set out the actions needed for London to become more resilient to extreme heat, alongside an investment plan for how these actions could be funded and financed. Through this work, we will assess different funding and finance mechanisms to better understand which options may be suitable to fund heat risk mitigation in the city. And as part of our research to inform the plan, we carried out an initial review of the landscape of funding and finance relevant to tackling extreme heat. And this exercise aimed to firstly identify the sources of funding and finance currently supporting heat risk mitigation, to examine the mechanisms used to mobilise these financial flows, and to understand where local authorities see opportunities to scale investment. And our findings show, unsurprisingly, that there's a clear adaptation financing gap. And while there are sources of public funding, we found far fewer examples of private finance being mobilised, whether that's through investment, lending, or other capital raising mechanisms. Most of the initiatives identified relate to flood risk mitigation or urban greening, primarily through public grants from national and local government. And although these activities do contribute to reducing heat risk, crucially, we found almost no funding streams dedicated specifically to heat risk reduction. And given the scale of need, grant funding alone won't be sufficient to close the adaptation gap. Through our research, we came across a couple of interesting mechanisms that help fund and finance heat risk mitigation, albeit at a smaller scale, which I'll briefly discuss some of those mechanisms that we came across. And the first of those are green municipal investments, which are local government issued financial products that raise capital through resident and corporate investment towards environment and sustainability projects. And the capital is then repaid by the government to the investors with interest over time. So it's a form of government borrowing at the kind of local level. Several London boroughs see these as successful mechanisms, which they would like to see scaled because of their strong community engagement element and good borrowing rates, frankly. And while this model has been used primarily for decarbonisation, a couple of boroughs have use this to fund adaptation, mainly in the form of greening or sustainable urban drainage systems, which yield cooling co-benefits. And there's potential to expand its use for adaptation more widely. Another example I'll mention are carbon offset funds. These are payments that developers make to London Borough Councils when they cannot meet carbon reduction requirements on site. The funds are primarily intended to support local decarb projects, of course, but in some instances have been used for projects that offer heat risk co-benefits, such as urban greening, simultaneously with kind of mitigation co-benefits. A final example I'll mention is the use of Section 106 developer contributions, which are charges on new developments normally used to support wider area improvements, such as transport or community facilities. However, we found that in a few cases, boroughs have also used this to kind of deliver greening and street cooling measures. And These mechanisms have kind of helped us understand what we're working with in terms of potentially funding heat risk mitigation in the city and the scale of the funding gap, really. Another part of our work also looked at identifying where there are potential opportunities for scaling that investment. And through our engagement with local authorities and GLA group organisations, we found that they expressed an interest in the heat risk plan to further explore some of these mechanisms, which we will be doing in the kind of coming months. And I'll mention what some of those are quickly. So firstly, Borough suggested exploring ways of leveraging existing government budgets, such as health, education and housing budgets, by embedding adaptation within essential service provision to help scale funding. Another one is expanding on the use of carbon offset funds to fund adaptation. And this is actually supported by an updated GLA guidance that broadens eligibility criteria for the use of this funding to go towards measures that promote both mitigation and adaptation benefits. And lastly, authorities also mentioned a desire to explore ways to engage private sector more systematically, including exploring things like blended financing models, public-private partnerships, insurance-based approaches to help de-risk investment, which I know is easier said than done. And no one mechanism will necessarily solve that funding gap. But in developing the heat risk plan, we aim to assess what those potential mechanisms are that could be used to kind of mitigate heat risk in London, and test these with a range of stakeholders to kind of assess what the viability of them are, to hopefully start plugging some of that gap to kind of become more resilient to extreme heat. Yeah, that's it from me on that question. Thanks.
Thanks, Jonathan. Some really great examples there, and clearly a large body of work undertaken. So we've heard about the wider landscape of funding and financing, and the heat risk example there for London. I guess to bring this to life with another concrete example of large-scale adaptation planning and investment, I'd like to turn to you now, Laura, on Thames Estuary 2100. I know that a piece of work has recently been undertaken by Deloitte and Arup, and perhaps you could introduce that and tell us a bit more about what you found.
Yeah, of course. Thanks, Ide. So I'm just going to share some slides. It's a similar case study to the one that Jonathan's just shared, but I'm just going to take you through the story a little bit. So as mentioned, I manage a team who deliver the Thames Estuary 2100 strategy. This is just a little bit about the context of what the strategy is set out to do. So the Thames Estuary is home to millions of people, property, critical infrastructure, transport networks, cultural and heritage sites, unique habitats and wildlife. There's also significant growth ambitions. So everything in the blue area on the map is at risk from tidal flooding, and a major flood could cause major transport hubs and critical infrastructure to close down. Businesses could suffer lost time and customers, and the region's reputation as a major business and tourist hub could be at risk. And the effects aren't just restricted to here in the estuary, but they would be felt nationwide. So all of that relies on a complex network of tidal defences, of which the Thames Barrier, of course, forms a critical, but not it's not the only part. So the network of defences work together to protect London and the estuary from flooding on what could be a daily basis in the future. But climate change is putting all of this at risk. So sea level rise is accelerating, and that network of defences is deteriorating faster as a result of climate change and the impacts such as the heat that we just talked about. So over the next century, many of the defences that form this network will need upgrading to cope with the higher water levels that we're seeing and the higher tides. So this is where the Thames Estuary 2100 plan comes in. So it sets out an adaptive strategy for managing this increasing risk. So to ensure that the estuary continues to be protected, that defence network not only needs upgrading in future, but it also requires maintenance and investment now to make sure it's fit for its current role and its role into the future. So this just sort of sets out what some of those interventions are that we'll need to do. So as well as the ongoing maintenance that you can see at the top, we've also got a series of deadlines by which our defences need to be upgraded by. So everything downstream of the current Thames Barrier will need to be upgraded by 2040. Everything throughout London the other side of the Thames barrier will need to be upgraded by 2050, and then there's another round of raising later on in the century. And the reason why that's sort of set out in that stepped approach is because of it follows the adaptation pathways approach that we mentioned earlier as well. So it's all about investing at the right time so that we're not kind of going too big or too early on some of these major interventions. So we also need to think about the future of the Thames barrier. So the Thames barrier's current lifespan, it's set based on current projections to keep operating sufficiently until 2070, by which point we'll need a new replacement option in place and operational. So we've got a decision point here, and by 2040 at the latest, on where we will decide on how we are going to replace that the Thames barrier. And as you can see, as you can imagine, there's obviously a significant investment associated with that, as well as the ongoing maintenance and upgrades that you can see at the top. But we don't just want to do those upgrades in isolation. The strategy is really about rethinking our riversides, so that we're not just thinking about building higher walls, but we're thinking about how we can reshape riversides to deliver multiple benefits. So how can we provide environmental improvements? How can we provide amenity benefits and social benefits, as well as obviously the kind of economic benefits of upgrading and protecting all that critical stuff that sits behind our defences. So this brings us on to our investment strategy work. So all of this, of course, comes at a cost. Over the next 15 years, we expect this to cost between around 14 to 22 billion pounds to deliver all the work that needs to happen in that period. There's significant net present social value of that work, up to 64 billion. But despite that, it's highly unlikely that government funding will stretch far enough to cover the sorts of costs we're talking about, particularly when we're facing similar situations across the country. So this led us to the need to explore alternative sources of funding and financing. So our investment strategy was developed by a team from Deloitte, Arup and Agilia. So we brought in experts, caveat here, I'm definitely not an expert in this space. So we drew on expertise from other places. And it's the first time the Environment Agency have really kind of looked into such a broad range of alternative options for funding and financing on this scale. And what the investment strategy does is it outlines a suite of emerging models which could provide funding for Thames Estuary 2100 and a detailed assessment of the options that are within those models. So each model has been evaluated against some key criteria, including the fairness, deliverability, and the scale of the funding or financing it could generate. The strategy also looked at how some of these options could be applied in different scenarios and in different adaptation strategies as well. But for the sake of what I'm going to show you next, this was really tailored to what we need to do in the Thames Estuary. So as part of the funding assessment, it sets out a series of models combining various funding options, and some of those we've already talked about, the things that Jonathan has mentioned specifically. So the longer term models you can see here in grey are those that require more significant legal, structural or policy changes, whereas the other ones are sort of more short term implementation. The models were designed to be building blocks of funding options that have similar characteristics. So they don't necessarily have to be implemented as whole models, but they kind of combine those similar mechanisms and the similar kind of beneficiaries or people impacted. So the first model you can see there is essentially what we do now. It's based on national taxation. And as you can see, the kind of potential for non-government funding is very low in that case. Model 2 brings in a range of local taxes and charges, and that has a bit more potential around it. So that includes some of those things like the CIL, the Community Infrastructure Levy, Section 106, as well as potentially increases in council tax or business rates. Number 3 looks at the wider taxes, so either London or wider. So it looks at how we could apply those same kind of principles on a different scale. And then number 4 is legislated insurance surcharge model, and also some reforms to the Act that currently allows us to claim back costs from riparian owners, those people who own property along the river. And then number 5 is essentially that this sort of taxes and charges, but with legislation backing it. And as you can see, there's obviously much greater prospects of bringing in non-government funding from those sort of legislated options. So it also looked at financing. So it considered a range of financing structures, as you can see here on the screen, which kind of reduces the short-term call on government funding, because it allows us to sort of get the financing, bring the money in from somewhere else, and then sort of repay that over a different time period. So it basically enables projects to proceed without adding to the government's reported debt. What we haven't done yet is think about the sources of that financing, or sort of the instruments that might be needed. So this is more about the structures that would enable financing to be put in place. So the emerging findings from this work, so it's clear that there's not going to be a single solution to this. We're going to need multiple funding options, and probably a phased approach. So some of these will be able to be brought in more quickly than others. We are likely to need new legislation for anything that is going to bring in significant levels of non-government funding, and that obviously brings its own challenges with it. We feel that we need some sort of London-wide or regional-wide charge, or potentially wider than that, to be put in place. The insurance premium surcharge model on paper looks like it could deliver great benefits, but obviously there's a lot of kind of feasibility that needs looking at around that. We would need to think about the proportionality of where the charges are placed and who is set to benefit and be impacted. So obviously, bringing back to that slide at the start, there's great benefits from continuing to protect the estuary, but we need to look at who are those beneficiaries and how do we scale the charges proportionately. And then finally, from the financing side of things, the regulatory asset-based model looked like the most promising approach that we could take forward in that space. So just to kind of sum up for where we are now, so we've kind of got our options in front of us, but we now need to do that that assessment of what's feasible and what's acceptable to our stakeholders. We need to get buy-in for any options we take forward, and really the decision will sit with government of which options we take forward. But like I said before, while these options and models have been assessed for Thames Estuary 2100, we really hope that this work could benefit others and prove a useful starting point for other adaptation initiatives.
Thank you, Laura. It's such an interesting example. I mean, I think seeing those funding models laid out with the percentage of non-government funding is really interesting to see it like that. Now I think to step back from a specific case, I'd like to turn us to a broader question again around what role can policy play in shaping private sector engagement and closing the adaptation financing gap. Jonathan, I'll come to you for that in a moment. And just to note, I see the questions coming in. We will come to those at the end of the session, so do keep adding to the questions through the Q&A function. But now, Jonathan, over to you.
Thanks, Eve. So before addressing the role of policy in shaping private sector engagement in adaptation, I want to start briefly by outlining the core challenges at hand, which has been mentioned by the other panelists and myself, which is the fact that adaptation financing gap, and the fact that financing adaptation remains far behind financing for mitigation. Securing funding for adaptation is difficult, and this is largely because of several structural barriers that undermine the financial viability of adaptation projects. For example, for mitigation projects, it's easier to generate clearer, monetizable revenue streams, such as electricity sales or measurable energy savings, whereas adaptation delivers benefits mainly through reduced risk and avoided losses. These benefits are real and often substantial, but don't necessarily translate into cash flows for the investors. A program to install green roofs, for example, can reduce indoor temperatures and mitigate the urban heat island effect, thereby delivering great economic and social benefits, such as avoiding costly health impacts and improved productivity. But these gains are dispersed and hard to monetize, and they don't translate into financial returns that easily from the investor perspective. As part of their work on the heat risk and investment plan, we're working to kind of better understand and map the financing opportunities available, as I mentioned, and assess the innovative financing mechanisms that are out there and explore what the role of public, private, and blended finance models could play in building heat resilience. We're also identifying key barriers to adaptation finance that Laura talked about in terms of kind of policy changes and the actions needed to address these. And in responding to how policy can play a role in shaping private sector engagement, I think it's good to briefly mention what some of those barriers that we'd seek to address with policy are. And in our engagement with local authorities, we've identified some of those barriers to private sector finance, such as first mentioned, the fact that adaptation projects generate low or uncertain revenue. So even when wider social economic benefits are clear, these are often public in nature and remain commercially unattractive. Secondly, the fact that data gaps on the cost of inaction and avoided losses do weaken the investment case, as we lack robust evidence on the current economic and financial impacts of extreme heat in this case. Projects also tend to be small scale and location specific, which means aggregation and therefore investment more complex. And lastly, high upfront costs and long payback periods further dampen private sector interest. From an investor's perspective, all of this shows up as reduced returns or increased risk, and this is exactly where policy could play a crucial role, or it should play a crucial role. And broadly, based on our understanding, I mean, policy interventions would fall into kind of two general categories. Firstly, they can focus on removing those underlying barriers to investment, which might mean things like using regulation to require or incentivize adaptation, or it could mean things like linking public and private benefits. So, for example, in the case of the Cool Roofs program mentioned, this could mean combining the public good of urban cooling with the private gains of improved aesthetics or higher property value. And policy can then be used to encourage voluntary contributions or tax those who benefit to help fund those very interventions. Secondly, policy can also aim to improve the risk return profile of specific projects, where governments can provide grants, concessional loans, blended finance structures to make investment more attractive, things that Andrew was talking about. And we are seeing this for decarb anyway, and to a lesser extent for adaptation. And we, through the heat risk investment plan, we're seeking to identify the long-term actions required to make adaptation investments, interventions more attractive, and exploring what the role that policy could play in this. And a core part of this work is also building a much stronger evidence base to inform that investment. And we aim to provide a clear information and data on potential revenue streams for different interventions, the cost and benefits that they yield, and the nature of the value they generate. So whether they're private benefits or public goods. This will help us determine where funding could come from. So where public funding is required, where private investment can be leveraged, and how both could be combined to fill the adaptation funding gap, especially where project won't be financially viable on their own. And finally, by working towards developing a pipeline of priority actions for addressing heat risk, which we aim to do, we hope to give investors a bit of a clearer line of sight on the opportunities over the near, medium, and long term. And this visibility and certainty that it could provide, we see as essential to kind of give public and private funders the confidence they need to scale investment in heat resilience. And yeah, that is essentially kind of the aim that we're trying to work towards with the heat risk plan.
Thank you, Jonathan. I suppose now we've just heard about that critical role that policy can play in unlocking private finance for adaptation, whether addressing risk, improving returns, or filling evidence gaps. But I think as we do that, there's an equally important question around balance and responsibility. And so, Sasha, I'd love to bring you into the discussion. to kind of speak to how do we ensure that private finance complements rather than replaces public responsibility for adaptation?
Absolutely, thanks so much. And I think it's a really interesting question, not least because sometimes the idea of public responsibility for adaptation doesn't feel like it's felt strongly enough across the board, but I can get into that a bit later. I think to start with, the main point I would make is that the opportunities and areas that private finance will flow into are often quite different in nature to the areas that are immediately covered by public responsibility for adaptation. And I think there are some places where private finance is more likely to flow into, and that's things like technological solutions such as wildfire detection mechanisms or air conditioning systems, and agricultural solutions such as the production of drought-resistant seeds, and then larger commercial investments in often climate-resilient infrastructure that might go through public-private partnerships. And I think those are examples where we do think that private finance is more likely to come in for adaptation. But even in those places, it isn't the case that every adaptation need will be easily financed by the private sector. I think when we think about areas like the need for affordable measures to adapt old or poorly built homes to more extreme temperatures, or those situations where homeowners really can't pay very much, the private sector isn't necessarily going to be able to provide the service in the form that it's exactly needed. So I think in those cases, it's very clear that public responsibility won't be replaced by private finance because private finance is unlikely to be interested or able to address that investment need without that maintained responsibility from the public side and probably some help from government. And Jonathan touched on some of the ways where government and other public authorities can help. I think another reason why this particular trade-off isn't one that I'm specifically worried about is because I think private financing need can sometimes be separate from the idea of public responsibility, because we know there's a huge amount that businesses and asset owners that need to do to improve the resilience of their own assets, operations, and supply chains. And while I do think that government needs to help those institutions understand their climate risk and understand what they need to do and how they can do it in those areas, the scale of financing that needs to happen means that it has to be more of a private responsibility because it simply cannot be absorbed by public responsibility under current financing. I think both of those reasons mean that I think that private finance always comes alongside public responsibility. And I think that just underscores the need for public responsibility for adaptation to be strengthened. And I think there's a lot more that could be done to make sure that that responsibility is felt properly and acted upon in an effective and decisive way. So if you look at some of the work that, say, has gone into CCRA4, thinking about what a well-adapted UK looks like, I think the public responsibility that comes in there is turning that from, that vision of a well-adapted UK into plans and policies and partnerships to try and make that vision a reality. And part of making that vision a reality is bringing in private finance, because we know that plans on their own don't get private capital coming in. I think we've been making plans for a very long time, both on the adaptation and mitigation side, and you do need to do extra measures to make sure that capital can then come in. I think we need to see policies, regulation, de-risking investments, and incentive structures so that we get closer to creating investable business models for the private sector. So I think all of this is to say that I think the interplay between private finance for adaptation and public responsibility isn't necessarily a conflict, but I think the most important thing is that public responsibility for adaptation is expanded a bit so that it really does include thinking about what we need to do to make private capital able to flow so that we are able to address the full scale of the financing needs. And I think that's been touched upon in some of the great examples that have been mentioned earlier in the webinar.
Thank you, Sasha. I appreciate that kind of note with the separation between private finance and public responsibility. I think that was really clear. Much of what we've touched on around risk and incentive and who ultimately bears the cost of climate impacts sit quite closely to the core business of the insurance sector. And Andrew, you can probably guess I'm going to invite you in here on this one. Given that, how can the insurance sector contribute to financing long-term systemic climate adaptation, given the industry's more kind of traditional focus on short-term risk management and solvency?
Yeah, I think it's definitely something we're being asked, all the time, and I think that's really where my role in the business that I sit in within the wider insurance industry really sort of comes into its own in that sense. So there's no doubt that policies in the insurance sector are written on a 1 or 2 year basis. You might get some longer term agreements, but that is the way that it is done. Short term policies. Now, certainly from a Zurich position, which I can speak more in depth on. I guess our view is that we are a risk partner and not just an insurer. So whilst the policies might be a year at a time, the relationship with the customer is often decades or even longer. And I guess that's really helping them on that journey around strengthening resilience, strengthening their business, because if you cut to the chase, and I can say this because I don't directly work in the insurance business itself, it benefits the insurance market and business to be helping support resilience. Fundamentally, the customer and the insurer want less claims. So actually investing and supporting in proactive risk management, in risk reduction, as part of that relationship that you have with a customer insurer, is really beneficial. And that's absolutely what is the bread and butter of Zurich Resilient Solutions. We are doing risk assessment work. So in my team, that involves climate risk assessments, but actually there's lots of different topics within ZRS that work on lots of other lines of business, around motor, around energy, around property, and others. And we're working in that, as I said, that proactive risk management space to then say, we want to make you more insurable, a better insurable proposition, because the insurance market at some point around climate change or natural hazards, as it is at the moment in the present day, at some point the appetite will reduce, the capacity potentially will reduce, and you really need to be top of that list or towards the top end, if there is limited capacity, rather than your competitor or peer who hasn't taken a proactive approach to risk management and isn't demonstrating that they are taking action to close that gap in terms of that risk that is being transferred. So that is certainly a space that insurers want to play, want to be part of the conversation. I think all the time when I talk to heads of sustainability, heads of climate, those people say, well, firstly, do you know your insurance and risk manager? And I spoke to a room full of sustainability professionals, about 100 or so. I said, by show of hands, how many of you know the name of and would speak to your risk and insurance manager? And no hands went up. So there's this disconnect there in terms of actually how can insurance and risk and that lens be used to really manage it. I think as well, even sort of rounding off the insurance process. So our claims colleagues are also, constructively challenging when major claims come in to say, are we just going to do this exactly the same? The go-to would be build something, let's talk about property, to build it back in the same place, the same spec, the same design, even if it's just been knocked out by a storm. Now, obviously, that is the cost it's insured to, and that's the reinstatement cost. So the default is, well, let's just do that. Whereas actually, our claims colleagues are trying to take a resilience and sort of future-looking view by saying, actually, use this as an opportunity. Is that the right location for that building? Is it facing the right direction? Is it the right materials? How do you future-proof and use this as an opportunity to become more resilient? And that's where this financing piece comes in, is to say, actually, then the gap is smaller, potentially, in terms of you have the reinstatement costs of a claim, and then the gap you have to fill potentially is smaller to have a really resilient design. and resilient materials and relevant flood defences, or like you're saying, Jonathan, looking at cooling, or how do you add in sort of passive cooling measures into buildings, by design. The UK building stock isn't like those on the continent, which are designed with, for airflow. We have problem heating our homes, and we are now having problems cooling our homes. So how do you do that and use that as an opportunity? So I'd say, yeah, the insurance industry has lots to say. Also, the last thing I'll say is we have lots of data and lots of information. We know how much lots of different floods and storms and other events have cost in terms of claims. We have lots of data around that, and that's what we use to model our climate data. So we have all that, and we want to be part of the conversation. So going back to me challenging these heads of sustainability to have a coffee with their risk manager, I would really encourage anyone in this space thinking about financing adaptation to bring your insurer or bring the insurance sector into that conversation, because you'd be surprised at probably the willingness to be invited in. We're not as big and scary as you think.
Thanks, Andrew. What a way to end it. Not as big and scary as you think. I am conscious of time, and I do want to move into the Q&A portion shortly, but maybe Sasha, if you have any kind of last reflections on that question.
I mean, yeah, I think Andrew's actually covered it very, very well. I mean, I suppose the way that we look at it is often at a higher level, but I think the key thing that we're interested in is with the big changes that will have to come to the insurance industry as climate risk continues to materialize in a greater and greater way. I think an increasing focus on shifting from risk transfer to risk reduction is really what's needed. And I think Andrew talked through some of those ways that we can do that. And I think there are so many different ways that insurers can help to advance adaptation. And some of those are, as you said, having a kind of longer form, more integrated relationship with insurers and policyholders so that you have more of an incentive to take some of the actions that might reduce your premium and make your whole policy more affordable. But there are also lots of things that insurers can do as institutional investors, thinking about some of the large-scale resilient infrastructure investment that we need. And also, and I mean, this is like a little bit further away, but when we're thinking about governments and national adaptation planning and the types of policies that they'll have to put in and the implementation side, insurers sit on basically the best climate, like actual climate risk data that we have. And especially, I mean, I'm more focused on a developing country lens, but thinking about once insurers start to be the people that really do know best where a lot of national focus needs to go in terms of both financing and policy, again, getting to a more integrated way where insurers are talking to government. They're also coming together to think about how different things can be financed to make sure that that liability is also manageable as they take on greater and greater risk. Thank you.
Yeah, I think that piece around institutional investors, insurers and institutional investors, and the data that is held there is really important, and also the coordination and engagement piece across sectors, which I think has come through quite strongly throughout. So that brings us to the end of the plan questions. I have an eye on the Q&A function here, so thank you to all who have submitted questions there, and thank you to our 4 speakers for such rich and thoughtful discussion. We've covered a lot. We did receive a number of questions on LinkedIn in advance of this, but I'm keen to get to those in the room, and I think actually between you've actually answered in part some of those that we received in advance, so we may come back to 1 or 2, but to start off, Andrew, there's a question for you there from Clive. He's interested in work on reducing exposure to risk. Could regenerative practices on farms be used in this way? to diversify activity and so reduce exposure to risk of the wrong weather at the wrong time of year, and hence food security risks in a more chaotic and warming climate?
I mean, the short answer is yes. I think getting ahead of some of this stuff, and I think this comes back to the sort of financing point, and sometimes people see adaptation as we're having to respond to something negative, i.e. climate change is coming, everyone needs to batten down the hatches and invest lots of money to protect ourselves. So I guess what Clive's speaking about here is actually the opportunity piece around some of this. So regenerative practices is an example, but other innovation, whether that's on technology or other sort of innovation level, is then say let's think about this as an opportunity, in terms of resilience being a driver for growth, for economic advantage, for market advantage, for cost saving. There's the figure that I think I've seen from a variety of sources where the range of it, for every dollar you spend on adaptation and resilience, you save, I think the range is probably even $5 and $10, and every number in between, so it's seeing that as sort of the proactive spend now for the cost saving and the advantage or opportunity going forward, which investors are starting to have that lens as well on the private financing side. So yeah, long-winded way of saying yes.
Thanks, Andrew. Jonathan, there's a question there for you around which authority has used the Climate Offset Fund to fund adaptation measures. Are you able to share that?
Yeah, no worries. I've responded to that in the comments, and happy to take that conversation forwards with Mary. Nothing to share at this yet in terms of kind of names and things, but I've got a couple of reports that might be useful to look at, and also happy to take the conversation offline.
Thanks, Jonathan. There is a question for you, I think, Laura, around 1.15 meters sea level rise assumes ice sheets remain stable. On current trends, that seems highly optimistic. The IPCC starting to recognise sea level rise of 2 meters by 2100. Do the measures outlined cover this, and how is any residual risk managed, and who owns or carries that? Is that a question that you're able to answer?
Yeah, absolutely. So the 1.15 meters is specific to the Thames estuary. So I think the point here is that we measure sea level rise locally, and that's important because there could be a significant difference to global average, and that's because of kind of local changes in land level, and also how the estuary's kind of been developed and over time, and how it's changed over time. So we work with experts at the University of Southampton to look at kind of observed changes in sea level rise and future projections. So the 1.15 was based on the IPCC, the UK CP18 projections, but based on the RCP 8.5 percentile, 95th percentile projection. So that's kind of what that was based on. But we are kind of seeing that the local observations are tracking that projection. So I hope that answers the question without going into huge amounts of detail, because obviously it's not specifically about funding and financing, but we are kind of planning for a broad range of changes. So the plan isn't just based on one projection, but it could, that's the whole point of it being adaptive, that it could look at how it could be used for different projections, and we also track locally so that we've got our own evidence of how the estuary is changing and how we need to adapt accordingly to that.
Thanks, Laura. Looking at the time there, I think we probably have time for 2 more questions, which means I'm afraid we're not going to get to all of those in the chat. Although, speakers, if you see one that looks like you might be able to answer it in a comment, please feel free to do so. Sasha, we'll come to you. There's a question there from Emer. How do you align the tension between public responsibility you described and the need for incentives and policy to balance the risk or costs when there is such a focus on local delivery for adaptation action? There seems to be a view that it is possible to unlock private finance at local or regional level, but the levers are rarely there.
Yeah, thank you, Emma. I mean, this is one of the interesting areas where, I mean, I mostly focus on EMDEs, and you actually see better examples happening there than you necessarily see in the UK sometimes. So I think in a development finance context, you do see more situations where there's, say, a blended finance loan facility, and you have a development finance institution that will cover first and second loss tranches of the loans, and then you can have commercial entities then offering affordable loans at a wider scale because that main bit of risk is already taken care of, and then they can do that at a local and regional level, very often with, say, agri SMEs. And translating that to, say, the UK, where we don't have development finance institutions that are, financing in the UK, obviously, but that blended principle still holds, that we do need financial institutions that have a public impact first mandate to really help to reduce risk on financing that then can be offered at the local level that's affordable and accessible to a broader range of people. And look, I mean, if there was both adequate resource available and then the adequate expertise at the local authority level, there's no reason why that shouldn't be happening, right? And I think we have seen some great examples in London already discussed, but it does require enough resource to trial new, fairly innovative mechanisms. It requires having teams of people within local authorities that can then start to navigate some of those, more difficult transactions. Like the most advanced financial institutions still sometimes spend years and years building blended finance mechanisms. And so it is a taller order for a lot of authorities that are trying to do so much and, only have a set number of people. So I think that you are right in that there are fewer levers at the local level. And I think unless national incentives can be set out that then lead to local financing, I think there will have to be growing capacity at the local level, and I suppose like a broader view on what public money can be used for. I think a lot of the time that is what this will come up against, in the public money, when it is as scarce as it is at the moment, then being used to de-risk private money. It is definitely unappealing to some, and in some cases it is totally inappropriate, and in some cases it's going to have to not be, right? And so I think that's a really challenging cultural shift that will also have to come, and I don't think we're necessarily totally there yet.
Thank you, Sasha. I'm afraid, being timekeeper that I am, I don't think we have time for any further questions. Although there are some great ones in the chat, so thank you so much for sharing those. And I'd like to just start by thanking our 4 speakers for such thoughtful and insightful contributions. And thank you to everybody who's joined us today at their lunchtime, much appreciated. And I just have a couple of points to share before we close. First of all, we'd really encourage you to stay connected with the work of the MACC Hub. You can do this by signing up to our newsletter or following us on LinkedIn. We share lots of updates and new research and upcoming events, all related to transformational adaptation. I think Shreya has popped those links into the chat there, so thank you very much. And we'd be really grateful if you could take a few minutes to complete our feedback survey. Your reflections help us to improve future webinars and shape our work going forward. There is a 3rd adaptation finance webinar in the works for later in 2026. So if you haven't had enough already, I will be back with some more. and that one's going to take a more of a kind of community and SME lens, so potentially addressing some of the questions we had there in the chat. And in addition, Giovanna has asked me to mention our transformation adaptation training survey, which we have at the moment, where we're trying to gather deeper insights into how transformational approaches have been understood and applied in practice, and what the training needs really are. So all of the links I think should now be in the chat. Thank you very much, Freya. And we will be sharing the recording with you after this session via email. So a huge thank you again for being part of the conversation today. And thank you to our 4 speakers.